Chris Preston.
And I'm Brad Simmerman.
And this is Street Check, the best podcast in the history of Cabot Wealth Network, or so my mother tells me. That's a lie. She's never listened to this. Brad, lots to get to today, including a very good guest we have. So I don't want to dilly-dally too much, but we talked a lot about your Vegas trip, upcoming Vegas trip last week. I know you and your wife were going in for more of the arts and culture route than the Dennis Rodman in the 90s strategy, but I'm most curious about, were you up or down at the tables?
We were up. So we stayed at the Bellagio, booked a massage for my wife right when we got there. Started off looking bleak, immediately dropped $300 on blackjack while she was getting a massage. And then had a really, really good run at the tables. Once she got out of that, she and I just tag teaming blackjack with a friendly guy, Mark, that was sitting next to us, and walked away in the black. She walked away with a pair of Chanel sunglasses, courtesy of the Bellagio's generous dealers. So it was a great trip.
Were they onto your card counting or no?
they joked about it because I'll do a thing where I'll be like, oh, we need this number right now, and every once in a while we'll get it. But no, nobody sees me as a serious threat. I'm a small fish. I'm not taking their lunch money.
Okay, good. Well, a Vegas success story. There aren't a whole lot of those, but I guess with age comes Vegas wisdom. Still, like I said, I've never been there. Okay, so Brad, tell people what we have on tap today, and then I'll introduce your defend the take.
So we're going to do a little bit of an abbreviated big three. We've got Nancy Zambell from from Cabot Money Club and Stock of the Month coming on a little bit later today to talk real estate, to talk her top picks. Cabot top picks, she's been doing those and liaising on those for a number of years. But before we do that, we're just going to get into a couple of our key takeaways to start the year, or takeaways from this holiday shortened week.
Yeah, and before that, as usual, we'll open with our defend the take. Brad, you're up this week, and your take is that all three indexes, S&P, Dow, NASDAQ, will close January in the red. Go ahead.
Yeah, so I'll get more into this with our takeaways as well. But as of right now, the markets are essentially priced for perfection, right? The soft landing narrative is in place. Everybody's optimistic about the Fed rate hiking or the Fed rate cuts coming. Although Bostic did have some comments yesterday that maybe put those a little bit more in doubt than the market is hoping. But there's also some seasonal factors that are in play. It is an election year. Some interesting analysis on election years, which typically are good performing, but not as well as we would expect. So high single digit performance is the average returns. But some and I don't know exactly where I read this. First half of the year tends to be really choppy in election years because there's a lot of uncertainty about what kind of policies new White Houses, new Senates, new Congresses will bring into play. But then it tends to outperform in the second half. So that sort of sets us up for a choppy January. On top of that, the Yale Sentiment Survey has retail investors the most bullish they've been since 2007. And I'm sure most of our listeners know that on the heels of 2007 came the great financial crisis. So investor sentiment, especially retail investor sentiment, is typically a counter indicator. When everybody is bullish, it's time to start selling.
There you go. I agree. I agree that the indexes will be down this month, probably marginally. Right now they're up marginally. S&P is like 0.5% up for the month. NASDAQ's like 0.75%, and those gains are almost entirely in the last few hours. Yeah, I see this as sort of a holding pattern month, and also just some normal consolidation, as we call it here, after the big run up in November, December. Because I don't think a pullback in January is an ominous sign for the rest of the year. I think it's just a normal, healthy market action.
And I don't give a ton of credence to the Santa Claus rally and that timing, but If you were to, I believe that the Santa Claus rally was a bust for investors this year, which could point to a lower January. And the other sort of adage is as goes January, so goes the year. I don't necessarily think that's true. I mean, obviously we'll see, but a negative January is probably not the end of the world given the run that we had to close 2023.
Yeah, no, I think it's actually a healthy thing. Okay, let's get to we each had one sort of big takeaway for this, like you mentioned, holiday shortened week. It is short enough, and we covered a lot last week with our jump ball segment and sort of an extended big three that there's not a whole lot new. Earnings season doesn't really get going till next week or outside of the banks. So I just sort of decided we should do one big takeaway. What is yours from this week?
So my takeaway is the markets climb a wall of worry. That's a pretty old adage. It's one that Michael Brush of Cabot Cannabis Investor has been sharing internally a lot lately. And another one that investors probably have heard is the market takes the stairs up and the elevator down. For the context of the wall of worry, I want to sort of look at the individual bricks of it. What happens is investors tend to look for counter narratives when it seems like, hey, the market's gone up so much it can't possibly go up any higher. But it's useful to remember something that I think Tim was always a fan of saying, which was that trends can last a lot longer than you think.
Yeah.
So if we're looking at the individual sort of worries that we're climbing right now, the VIX has been trending higher since the end of last year. It's setting higher highs and higher lows. It's still below 15. I believe the sort of technical risk level is above 1560, and it knocked on the door of that a couple of days ago. At the same time, we've got a lot of fear that earnings simply won't be as good as people are hoping for, or maybe as some of the more value-minded investors believe that they would need to be to continue driving share prices higher. We've talked a lot about how the Magnificent Seven stocks have been so dominant. That's another sort of element of worry. You think, well, everybody already owns the Magnificent Seven stocks. There's no way they can keep going higher. Nvidia's at fresh all-time highs. It's picked up something like 100 points in the last 3 weeks, I think. I'm just pulling that out of my head, so I don't know definitively. We've got the seasonality trends, right? The election year, we've got those fears in place. What I just talked about with the things that make me more bearish in January. Global conflict, right? That's that black swan sort of outside factor that you can never account for. But I think Bruce said it really well when he was on with us recently. He was talking about Charlie Munger, and one of the takeaways from Charlie Munger was, don't try and go out and be smart and be like the clever guy that outthinks the market. Go out there and try not to be the dumb guy that's making mistakes.
It's like your approach to the Vegas tables, probably.
To be the smart guy.
No. I'm saying like you don't be dumb. Don't make mistakes.
Yeah, and so one of the more common mistakes in investing is trying to call tops and trying to call bottoms, right?
Yeah.
So it's like you get the feeling that, all right, well, this market can't have any more legs. I have to get out because it's topping out. Don't do that. Zoom out. If you're worried about right now, look at a 2-year chart. A 2-year chart shows a really strong uptrend for the major indices. If you're still worried after looking at a 2-year chart, look at a 10-year chart. Even with the March pandemic correction, we're in a solid uptrend on every major index. And if you're still worried about it, then look at a 100-year chart. I mean, that's been growing. Equities have been growing strong for longer than either of you have been alive, longer than we've been alive combined. So that worry narrative that sort of builds up, instead of trying to be the smart guy that calls tops and says, all right, well, it's definitely reversing. Try not to be the dumb guy and say, okay, well, what's it do over a year or 2 years or 5 years or 10 years?
Yeah. It's funny you mentioned 100-year chart. Mike Santolo, our expert market timer and growth investor, had a webinar yesterday where he showed a 100-year chart of the S&P, and it showed that if you look at things from the 100,000 foot level. Basically, bull markets trends usually last, bull markets are usually 10 plus years, a lot of times in the teens, and then bear markets, can be, while shorter, last years also. And he showed that if you look, we're basically 8.5 to 11 years into a bull run. Now, we had a bear market in 2022 and early 2023, but he's more talking about just really high level trends. And he says that means we're sort of in the 6th to 7th inning of this, I guess, secular bull market. So if you look at it from that perspective, like you mentioned, the long-term outlook doesn't mean we're, bull markets don't die of old age. I can't remember who said that one, but it might have been a Tim or something. But again, we're not historically up against some abnormal, run. I mean, again, we just came out of, real misery for the growth stocks in 2022 and most of 2023. I'll do my takeaway from the week. Fed, surprise, surprise. We sat here and talked about the Fed last week, how we really doubted, I think we both doubted that despite 77%, or maybe it was down to like 70% by the time we actually did the podcast, expectations that the Fed would cut rates or do their first rate cut in March. It's now down to 50-50 proposition, according to the Fed Watch tool. 50%, 500 to 525 basis points in March, 48.7% that they hold firm. I think their language this week is really, not all of them, but Raphael Bostic, who you mentioned, came out and he said he thought Q3 would be when they would start, and he's projected 2 cuts, 50 total basis points for the year. Loretta Meister, March, she said March was probably too early for a rate cut. So they're telling you, they usually telegraph these things. They've been telling us, and I figured this all along. It seems like the reaction of the market is a little overly jubilant when they're wanting to see the dovish comments and sort of say, okay, that means they're going to do this now. They want like instant gratification. So I think some of it is wishful thinking. But while I think cuts, I still think 3 cuts is pretty realistic, but I don't think the first one will happen until May. I thought that before, and I think it now even more so that May will be the first one.
Yeah, just some context for Bostic. I was looking into this a little bit more back in 2021, 2022. He was on the rates are higher for longer side. He was calling for 6 hikes of a quarter basis points a piece. So he was on the conservative side when rates were rising. It stands to reason that he's simply being on, he's not more dovish. He's simply on the more conservative side now that rates are falling. So he was saying quarter point hikes. We saw plenty of 50 basis point hikes. So he was a little bit on the cautionary side then. I fully expect him to be on the cautionary side now, and that we'll start seeing hikes in May, June would be my guess, and probably a little more aggressive than the way he's positioning it. I will say, in his credit, he's been very correct about his overall assessment of the economy as a whole and the Fed's course of action, but just not the scale that they're moving at, or even necessarily the speed at which they're moving.
Yeah, and the good news is that despite these comments, comments like these used to, really weigh on the market. Maybe it did, but as we sit here, the market is at, flirting with new all-time highs. If the market does pull back in January, like you and I both expect, I don't think it'll have a ton to do with the Fed. I mean, they're meeting until we hear from Powell, which is literally the last day of the month. Maybe if he comes out and echoes what they're saying and sort of hints at, hey, it's not going to be in March, or says enough to make people think, okay, it's not happening in March. Maybe that'll have a very short-term effect, but I don't think it's going to be the market sort of anvil holding down the market like it was for, better part of a year there. Okay, so let's move on to our guest for today, who is Nancy Zambell, as you mentioned, editor-in-chief of our uh, Cabot Stock of the Month, the Cabot Money Club, and we'll bring on Nancy in just a second. All right, we welcome on Nancy Zambell, who is editor-in-chief of Cabot Money Club and runs the Cabot Stock of the Month service within that. Nancy, welcome. You were on here a few months ago with us to talk housing when things were a little dire. Well, at least nationally looked a little dire for the housing market. It was mortgage rates were up close to 8%. But you said then you were seeing some good signs where you are. So you're both investor and a realtor. You said you were seeing some good signs there where you live in Tennessee. I imagine have things gotten better? Have rates have dropped now to 6.6%?
Yeah, they have been getting better, although this is typically a slow time for Tennessee real estate, and especially
Right.
now that
Yeah.
we're in the frozen north, I'm gonna have to get an igloo or something, I think. But
Yeah. Right.
yeah, the rates have dropped to 6.6 from right around 8%. And I had a long talk yesterday with one of my mortgage guys, and he told me that his company is predicting down to 5.5% for 2024. First time that
Oh,
I've heard under 6, but now we're starting to see it everywhere, which I think will start moving the market. I mean, our two biggest problems right now, our challenges are the rates and, of course, lack of inventory, though that is increasing. In fact, inventory for November was up in Tennessee almost 20%. So
wow.
we're now at a little over 3.5 months of days on market inventory. My particular area, which is the Knoxville region, not quite so much. I mean, we're still at about 1.5 months of inventory. And we've got, like, for instance, in Cumberland County, which is one of the areas where I have an office at, there's like 200 and some listings right now. Typically, they carry about 1,000 in just a normal market. And in one subsidiary up there, Fairfield Glade, there's 55 houses on the market. Normally, they would have 250 this time of year. So, we're people are. It's not like it was 2 years ago when you put a house on the market and you had 25 people lined up to buy it. It's taken a little bit longer right now. People are thinking, well, maybe I'll wait till spring because inventory typically will increase then. But I have buyers who are looking. I mean, I have two buyers, one at 1.5 million, one at 1 million, one about 750,000, and I can't find them anything. So we're just kind of waiting to see what's going to pop up.
Yep.
We sold a couple of houses this week and at decent price ranges. So, it's coming along, but they're saying that prices nationwide are going to increase 3 to 4% this year, which is normal. I
Yeah.
mean, in our area, 4 to 5%. But I was looking at one article I saw, and I was born, I'm not going to tell you which decade, but the
Late
prices of
70s,
homes.
right?
Yeah, exactly. The average price of a home at the time was $7,354. And today's inflation adjusted dollars, that's really just $93,500. So you can see that prices of housing have really gone up because you can't buy anything for $93,000. You
Right.
can't even
Yeah.
buy a mobile home for that today,
Yeah.
not with a piece of land with it. So it's kind of interesting to see because, typically people will say housing is not an investment unless you're a real estate investor. It's where you live and where you enjoy living and all that. But it does prove to you that over time, if you hold it long enough, generally it's going to go up. But again, I don't advocate that people go and buy houses just for the investment potential unless they're going to rent it out or buy it at a good price, flip it, and make some money on it.
Right.
Yeah, that it's interesting that it's positioned that way. I've always heard that it's one of the most well-established paths to sort of wealth for the average middle class American family is through home ownership. But when you say don't approach it as an investment, well, think about it from a liquidity standpoint or a cash need standpoint. If you're an investor and you live in your most valuable asset, if you run into a rough patch and you need to generate liquidity, you can't do it. In today's interest rate environment, even something like a home equity line of credit or something like that becomes unattractive, although potentially doable. But yeah, I do think that approaching it as something that you should expect to increase in value over time, at least for the years to come, is a reasonable expectation, but you can't treat it like a retirement fund.
Although, now that you say that, Brad, you sort of can. If you have a home and you've had it for 30 years or 40 years,
Mhm.
guess what? It's paid off when you retire. So that's one huge amount of expenses that you don't have to have when you
Yeah.
retire. So, but I know I have had a lot of clients too over the years that said, I'm 75 or I'm 80 and I'm going to sell this house. I'm just going to go rent somewhere because I mean, how many years am I going to live? And I don't want to
Yeah.
do the maintenance. And I don't want my kids to have to hassle with it when I die. So there's a couple of different ways for looking at it. But when you start getting toward my age and you start thinking about retirement 20 years in the future, then you say to yourself, geez, it'd be nice to have a house that was paid off. That would give you a lot of financial flexibility.
Right. Yeah. And sort of tying it into investing a bit, as mortgage rates come down and Fed is set to cut rates sometime later this year. How many times we don't know, but likely they're going to. Um, are there housing stocks or ETFs that have sort of caught your eye lately that seem like a good play right now?
No, not really. I
No.
mean, the big builders have sort of had their heyday back the last couple of years.
Yeah.
I think with building supplies are still going up. I talked to someone this morning and I heard that plumbing supplies have gone up 8 to 10 times, not 8 to 10%, 8 to 10 times what they were 4 years ago. So that's that's a real issue with the builders. I mean, they're still making money, but I haven't seen any that look fascinating to me. I mean, I still love the REIT market, but it's kind of touchy when you've got high interest rates. It's kind of hard to invest in REITs. But one of the other articles I saw was about multifamily housing, because honestly, a single family home has almost become out of reach for someone who's looking like somebody getting out of college. When I was I think it was 25, the first house that I bought. People can't afford to do that anymore. So, you look at multifamily housing, and I think that, and I don't have any of the names of the multifamily REITs off the top of my head, but I think those might be something as rates start coming down to look at, because, they have to finance all that with interest, and it's pretty expensive right now.
Okay. Yeah, I tried adding Zillow to stock of the week a few months ago, and I think I was a little premature.
Yeah.
It didn't work out great, or hasn't worked out great, I should say. But I was trying to play it from, just a non-home builder route. But yeah, you still don't see, as bullish as the market has turned in the last 2.5 months, you still don't, at least among Cabot advisories, you still don't see a ton of housing related plays.
Right, right.
Yeah.
I think somebody wrote up one the other, maybe today in the Daily. What was that? Was that a REIT?
Oh yeah, well
There,
yeah,
Alex something
that's
other.
right. That's true.
Alexandria was in the Daily today. They're technically classified as an office REIT, but they invest in laboratory space,
Yeah.
which is
Yeah.
a big distinction, because you can work from home if you're a financial analyst, or if you're a writer, if you're an editor. You can't work from home if you're a lab technician or a research scientist. So I do think that's a really interesting angle from Tom Hutchinson today.
Yeah, that is interesting because, in speaking about the office environment, I mean, that's pretty challenging right now. There are a lot of empty office buildings, and it looks like from some of the articles that came out this week that all of these bigger employers that were trying to force their employees back into the office hasn't been working so well. And so it's kind of become a sort of a hybrid thing with saying, okay, come in 2 days a week and then you can stay home 3 days. So a lot of people don't need as much office space because you're going to see people sharing offices, because why would you get an office if you're only in 2 days a week, right?
Right.
Yeah.
Yeah,
So that's
exactly.
still interesting.
So
Yeah.
Jamie Dimon spoke at Davos, who's CEO of JP Morgan Chase, and he had some comments on the commercial real estate market and how it's impacting banks. Essentially, he laid out three possible paths forward. One is soft landing. Big banks are fine, regional banks are fine, commercial lending isn't really an issue. Hard landing, but if rates are lower, is going to be a little bit painful for the banks, but not really problematic. Hard landing, but if rates actually tick higher or stay at these levels, so if we don't get commensurate rate cuts from the Fed, that's where it would become problematic. So I do think that that's an overhang for everybody to be worried about, but it's probably more of a worry than it is, something that we're actually going to experience.
Yeah, it'll be interesting. Someone asked me the other day, is like the amount of realtors in the industry now, and was that going to fall? And I think we'll definitely see that in the commercial space because there just won't be
Yeah.
as much office space to sell, and we will definitely see it in the residential. For example, back in 2007 to 9, when we had the recession, and one of the areas I work in Cumberland County, there were about 320 realtors at the time. By 2009, that was down to maybe 215 or so, because that's what happens. The people that get in think they're going to make a lot of money really fast, to get out pretty fast too, because they realize that they go a few months without a paycheck, and
Yeah.
that's pretty tough. But we're starting to see, I mean, even in some of the smaller towns here, a lot of empty space in the business districts.
Yeah. Yeah. No, I see it in Vermont. There's sort of a corridor between where I live just outside Burlington and Burlington. There's one route that I, drive all the time, and it's more empty space for sure now than there was pre-pandemic. I mean, not that that's unique, but you would have thought it had been going the other direction, sort of making a comeback lately. And it's sort of been trickling, there'll be another empty space that pops up every few months. So yeah, we're sort of seeing that here too. Moving on to just the general market, as I mentioned in Money Club, you just had or it's Cabot Stock of the Month, you just had your annual top picks for 2024, which is features various Cabot analysts, like Tyler, Bruce Kaiser, Tyler London, Bruce Kaiser, Mike Santolo, Cliff Droke, and I all contributed to that. Without giving away the picks, was there sort of a theme from what you gathered, or was it sort of all over the map? I guess, was there more, could you feel the optimism more now than you could probably a year ago?
I think so. I think some of the picks were maybe a little bit more speculative than what we would have had a
Right.
year
Yeah.
ago. I mean,
Yeah.
as you guys know, sector-wise, technology stocks were the winners last year, and they were up almost 52%. And
Yeah.
we still got a few technology companies in as top picks. I mean, we had an education app. Let's see, an organ transplant technology, optical display technology. Let's see, EVs, AI med tech. And those were the technology companies. But then we also had an industrial equipment company, a McDonald's franchisee, a global McDonald's franchisee, and a big money center bank. So, but mostly they really were, probably 7 out of 12 were technology companies. So it's going to be kind of interesting to see what happens with that. But yeah, as I said, I think they were a little bit more speculative this year.
Right. That's a good sign.
Yeah,
Brad.
it is.
Yeah, so one thing that, and I haven't looked at statistics. We've talked a lot about the S&P's performance X the Magnificent Seven tech stocks. I'm curious, and I don't expect an answer, but I'm curious what technology's performance would have been as an S&P subsector without the performance of those same Mag 7. So we look at a 52% return or a 53% return for the tech subsector. How much of that is overweight? Or is overweighted by the Mag 7? And are there other technology names that, you look at the heels of the sector performance, there's still a lot of sort of value in that subsector that's also being distorted. So leaning into tech doesn't strike me as a yellow flag even. It seems like a green light for me if we do have this broadening bull market in stocks.
Yeah, and what's interesting, Brad, the last few years is that it's been the mega tech companies that have been the big winners.
No.
Now, I was a veteran of the boom and bust in the technology industry and the whole .com thing years ago in around 2000. And back then it was companies you never heard of. Companies that never made a profit on anything in their lifetime. They hoped to make a profit, but most of them went out of business within a couple of years. So I sort of have a feeling that we're going to turn technology a little bit and go back towards some of the more speculative names, because how much more value can you get out of Google or Intel and
Right.
Microsoft and IBM?
Yeah.
But the problem with investing is you don't know which ones. Who were
Right.
the Microsofts of the future? I mean, I just met up I was in Florida because I took that cruise in November, and I met up with a bunch of old friends there, and we used to have an investment club together 30 years ago. And one of them reminded me that he and his wife had bought Microsoft back then in our club. And I
Wow.
don't know what the price of it would be after all the dividends. I'm going to say they probably rented about $3 a share.
No.
So they
Wow.
certainly sent both of their kids to engineering schools, and and now she's retired and he's contemplating retirement and off of that one stock. And of course, Microsoft was still a big company at that point in time, because this would have been in the probably mid to late 90s, I'm going to say. But those are the kind of companies that you hope to find. And honestly, when you look at some of the stuff that Mike and Tyler do, they find a lot of those companies.
They do. Yeah. Yeah. Hence the speculation. You got to, take swings at what you think could be the next, Google, Microsoft, Apple, whatever. And, we've landed on them. Tim Lutz.
Oh God,
2011.
Tim's like the king in my mind, honestly.
Yeah. So a
Yeah.
former chief investment strategist at Cabot, since retired. Tim Lutz, 2011 December, Tesla, and we've had at our subscriber conferences, we've had people come up and say, yeah, I made $1 million in Tim's recommendation. I own a Tesla. I own a house because of Tesla. So yeah, those are the the diamonds in the rough that you dream of. So yeah, that's where the speculation in your issue this year, that's what they're looking for basically.
Yeah,
Importantly, it's a climate where they feel like they can find that right now.
right. And you hate to say safely, because there's nothing really safe about any kind of investing, but it's about as safe as it can get in terms of buying speculative stocks, because Mike and Tyler both have proven themselves to be right on top of every movement. And,
Right.
and they watch out for you. So it's not like you're going to just say, oh, here, buy this stock, and you never hear from them again.
Right. Yeah, exactly.
Very much a let your winners run and cut your losers short, because
Right.
you were talking about the .com bubble. The thing that my mind always goes back to is pets.com. I don't remember what the market cap valuation was, but
Yeah.
that was a heavy hitter for a number of years. And absolutely cratered and didn't bounce back. So you need to be able to get out of that at the right time when the writing's on the wall. But if you do get lucky enough, I had a client years back that had almost their entire net worth in Amazon. And, that's not something that any professional advisor would advocate. That's certainly not something that we would have advocated. Having all your money in one stock is very risky, but due to some peculiarities of their lives, they just hit on, hey, this is going to be transformative, and made them millionaires multiple times over. That's sort of that investing with commitment, and then when you've got a winner, stay in it until it tells you otherwise, right?
Yeah, yeah. And the problem in the newsletter business, as I've said before, is that you only have a finite portfolio. We can't tell our subscribers to buy 50 shares or 50 different stocks, because you have to make movement in the portfolio. So you don't really have much room to say, I'm going to just keep this one in here for the rest of my life. I mean, there are some newsletter writers that have done that very successfully, but we tend to move our stocks around a little bit. But one of the things I was just going to comment on your comment, Brad, is that there's really two ways to look at these speculative companies. Is one, if you do get a winner that rides a long time, it's great. But the other thing is, think about who wants to buy that company, because that's how a lot of those companies have, and their founders have become zillionaires, because they had this great thing that Microsoft or Intel or Amazon or Google wanted to buy. And of course, again, little old me, we don't know which one of those technologies is something that Google is just hungering for. But, it's always something to keep in mind. It's kind of like, well, it's not kind of like, but it's somewhat similar to all the years I spent in banking, is that you would buy shares of these little, small, local community banks, and then a regional bank would buy them. And then a money center bank would buy the regional bank. And yeah, the guys in the beginning, they all got rich off of it. But, it's one of the reasons that you buy small bank stocks is to hope somebody's going to buy them out.
Right. Yeah. And one last thing, I know you investor sentiment is something you monitor closely. How is that? I'm curious how that's been trending. Has it been trending slightly more bearish this month, or is it still pretty bullish? I know Brad had a stat earlier, but my sense is it's still pretty bullish out there.
It's very bullish, but it's tending a little more neutral. Not
Okay.
so much bearish, but more neutral. And I just looked at them again this morning, and just from the ones that I shared on our prime call on Wednesday, things have changed a little bit with the individual investors. They've become a little bit less bullish and a little bit more neutral. So, but still, everybody is still by and large, over 40% bullish.
And what level does that reach? I know there's an indicator for Mike Santolo is when things get too, he looks at the sentiment, and if things get too bearish bullish or bearish, he tends to go in the other direction. Has it not reached that? I mean, I guess not now if they're trending towards neutral, but is there a level you look for where like, this seems a little too overzealous?
It's not even so much a numerical level. It's
Okay.
more of looking at all of the sentiment indicators together and just seeing how they change from week to week and the kind of things that people are buying. That
Mhm.
probably tells you more about sentiment than anything. If they start getting really speculative, you're like, oh yeah, it's like, when before the recession, I was in New York City and the cab driver was telling me which stocks he's
Yes.
buying. I'm like, okay,
That was
time to
always
get
Tim's
out, right?
rule. Yeah,
Yeah,
exactly. I mean, like the sort of more modern day version of that was the meme stocks, and
right.
February 2021. That was a tell, like, oh, I think we might be running
Yeah.
out of time here on this.
Yeah,
And
and
sure enough, yeah,
you look at the stocks that are advancing and not just, sectors, but and they tend to go in sectors, but you look at individual stocks and see which ones are people really buying into. And I know that both Andy and Jacob both look at all the app options activity too, which I don't really know that
right.
much about options, but those are big indicators of which direction the market is going in. But when you start seeing a lot of individual investors getting into the market and they're all thinking bullish, then it's basically run.
Yeah,
Because they typically are not good barometers of what the market is going to do.
right.
Yeah, you mentioned the meme stocks. Bitcoin is the other one
Yeah.
of recent history, and even despite its really impressive price performance last year, we weren't seeing that sort of frothy speculative buying. It was all pretty much premised eh, on approval of Bitcoin ETFs, sort of devaluation, and it still doesn't do anything. Um, but the price movement has been constrained in a way that's been sort of reasonable and not frothy and bubbly in the way that it had been in 2021. And like like you were saying, Chris, the meme stocks haven't exactly roared back. I think they maybe showed some signs of life a few times, but we started this conversation, Chris and I did, talking about the wall of worry that the market climbs and long-term trends, and it very much feels like those are still intact, at least in my opinion.
Yeah. I mean, what do you think is going to go on with Bitcoin? I mean, it went up a lot recently.
Yeah, it's funny. We've talked about this a lot, and I've made some bold predictions. One of which I got right, that the Bitcoin would top 40,000 before oil got to $100 a barrel. It was close,
Mhm.
but oil retreated, and my thing is the Bitcoin is purely a bull market play, and then once that sort of tops out, so the last time I think it topped out at what, 65,000 was the high
Yep.
in 2021, Brad, and now it's in like the low to mid 40s. So it's
Yeah.
not, like you said, not frothy. If that gets back up to those highs, that'd probably be a bad sign.
Yeah.
And that would, as soon as the market starts to crater, Bitcoin will too.
Yeah.
Yeah,
But yeah,
what
it has no, like Brett said, it has no utility. It's just,
Right.
a good speculative play.
one of the sort of core bull theses of most cryptocurrency investors is just wait and see what happens when there's mainstream adoption of the asset class, right? When people are sending money instead of using Zelle, you're using cryptocurrencies. Um, I do think that we're at a point, we're at an inflection point for that. We have Bitcoin ETFs now.
Mhm.
Every institutional investor that wants to buy Bitcoin can go out and buy an ETF, and they don't have to worry about custodying it. They don't have to worry about the web security behind it. They don't have to pay Coinbase commissions anymore. They can go buy a BlackRock Bitcoin fund. I'm actually quite bearish on Coinbase as an investment because a lot of their revenue was driven by trading. Trading has been really muted. And
Mm.
now, if there is widespread adoption or widespread investment in some of these cryptocurrency assets, it's not going to be through Coinbase. It'll be through the ETFs. Um, the daily did highlight an arbitrage opportunity with Grayscale Bitcoin Trust that was pretty spot on, because that was trading at a discount to its net asset value. And the assumption was that if it converted to an ETF, that would normalize. It has. I don't really see a lot of upside until exactly like what Chris was just saying, until we get to the over-enthusiastic bull market, when people are looking for anywhere where they can leverage returns, where they can maximize their gains, where they can find, that thing we were talking about, be smarter than everybody else and find this asset class that's really going to outperform. And we're not there yet. Maybe we get there a little bit, but I think that bull thesis of just wait until the big banks are in, I think that's going to be disproven this year.
Yeah. Well, it'll be interesting. I mean, I would wait for a pullback to do anything with it, but
Yep.
Be nice if it went back to 16,000 again.
Yeah. It was 16,000 in at the beginning of this year.
I know. That's what
the daily said, right? The daily told you to buy then.
Yeah.
Nancy, thanks so much for joining us. And I just wanted to give a plug for, as we mentioned, you run Cabot Money Club, which contains, among other things, Cabot Money Club magazine and Cabot Money Club Stock of the Month, which featured the top picks from Cabot Analyst this month. It frequently features in-depth interviews with analysts, featuring a new stock pick, sort of rotates through all of our analysts. And there's reports that come with it. You can find it under the premium memberships tab on the cabotwealth.com site. I highly recommend it. Nancy's been with Cabot. How long have you been with Cabot now?
10 years now.
10 years.
Yeah.
Okay. Oh, so you're same as me, actually. Okay. So
I think didn't I come a little bit before you, I think.
I think you did. Yeah. You did. Yeah. But any sort of last words of wisdom before we sign off?
No, I just think that people have to realize that there's no get-rich scheme in the stock market. It's, in my opinion, is that to buy stuff at the right price and sell it at a higher price, right? And hold on to it as long as you need to. But that's my words of wisdom for the day, you guys. Thanks so much for having me.
Thank you, Nancy. We appreciate it.
Okay, bye-bye.